joining us now with more analysis on the developing situation is former SEC Enforcement Branch Chief and Bragança Law Attorney, Lisa Bragança. Lisa, so we've been monitoring the arrest of Do Kwon, the founder of Terraform Labs, the creator of the Terra blockchain, which infamously wiped out $60 billion in market cap with the fall of Terra USD and Luna. So how does this arrest affect companies in this space moving forward? If you could start us off.
Well, I think the arrest itself doesn't have a very big effect. I think the SEC charges actually made that clear that regulators are not happy with this type of offering. And it's very consistent with what the regulators and Chairman Gensler have been saying all along. So I don't think this changed anything substantially. I mean,
I guess, sorry, Lisa, just a follow-up. So I guess what people are interested in is, like, what are the charges that the SEC have against Kwon? Because it's one thing to fail at a business, but it's another thing to be charged. So what did he do wrong here?
Well, the very central to the SEC's complaint is the fact that there was a point early on when the Luna and Terraform were not stable as they were supposed to be. And the algorithm that Do Kwon said was in place was supposed to cause them to be come back into balance and be stable coins. In fact, the SEC lays out in detail, Do Kwon went to a third party to get a big buy into the tokens to prop it up. That's market manipulation. And then we have a misrepresentation because he didn't disclose that. After that happened, people piled into these coins and, believing reasonably, based on what he said, that this was really a stable investment, that these were stable coins, and they weren't. And in May of 2022, when there wasn't somebody who could come in to prop up the entire market, that's when things collapsed.
So, Lisa, what's interesting about this is that obviously this was not a U.S. project. It was not a U.S. company. It was not registered here. So clearly that the charges are all based on how this impacted U.S. investors and U.S. markets. Can you spell that out for us exactly? Like, what are they saying? So we know that U.S. investors were investing in this, but like, how does the SEC and how does New York, how do they spell out the impact specifically on Americans?
The SEC complaint and the indictment specifically point to conduct occurring in the United States, specifically in the Southern District of New York for the indictment. And the SEC points out that there were lots of U.S. investors who lost their life savings. There are more sophisticated institutional investors that lost billions. So I think their contention is that Do Kwon and his folks were reaching out to U.S. investors, whether they were based in the U.S. or not. They knew that they were getting U.S. investment money, and frankly, they were targeting their pitch to U.S. investors.
Right. Yeah, I think that's an important distinction, because it's not so much that like U.S. investors found their way to them. That's usually what they get them on, right? Some kind of marketing or some sort of targeting to Americans.
That's right. This isn't made up of, you don't see people trying to defeat efforts to block U.S. investors here. There was outreach.
To any of the fund managers who might have been very vocal about their support of UST/Luna and may have put in a few $1 billion or at least several $100 million of their capital and the like into it, are they possibly liable as well? Do they face any potential charges, or would that depend on what comes out in a trial?
Well, facing charges, I think they do face charges, and it's not clear whether there is a factual basis for bringing charges. I mean, clearly we're hearing about that with the FTX situation. It depends whether the charges would be valid, whether they would have some factual basis, depends on exactly what those entities knew at the time they invested, and frankly, at the time they pulled out. They could potentially be charged with maybe even insider trading for pulling their money out when they knew that when they had material non-public information that this was all coming down.
Lisa, this is kind of a tough question. I don't know the answer to it, but maybe you do. So, right now there's all this talk in Congress and just everywhere, like the U.S. needs to do more, U.S. needs to do something. But what could the U.S. have done to prevent something like this, right? I mean, U.S. investors were very materially harmed, but it was a non-U.S. company. I mean, is there anything that could have been done here in the U.S. to prevent this kind of harm to U.S. investors?
I think the problem here is that U.S. investors want to invest in crypto, and the U.S. is not welcoming and not setting up a a favorable or even not
any kind of
companies to be
guidelines
based here. This is something we've talked about a lot. We have an environment where certain entities have gone to the SEC and repeatedly met with the SEC officials to try to fit within the current regulatory structure. And, the current regulatory structure is extraordinarily complex, has lots of special, provisions for specific types of investment products, but there is a resistance to coming up with those rules for crypto. Right now, crypto is being asked to fit into the box that
Lisa, I totally agree with you. As you know, this is definitely, I've been making this point for weeks now, but there is one thing in this case that I think we do need to mention is that a very, innovative financial product like an algorithmic stablecoin probably wouldn't have been allowed in the US anyway, right? This kind of, Do Kwon invention, even if the US did get its act together and had super clear regulation, these kind of really sort of Wild West financial instruments are probably still not going to be allowed here, right? So I guess that's sort of the question, it's what can you do in that situation? What can you do to prevent, investor harm when you have these sort of wild innovations that are happening, that are not probably never going to be allowed here in any material form by, most of it.
There are always going to be big losses when there's new innovation like this. We saw that, when the railroads, the 1800s, when railroads were a big innovation, lots and lots and lots of people, most railroads went under and investors lost everything. We saw it in the .com bubble. No, that doesn't mean that railroads were a bad idea, and it doesn't mean that, we're not all shopping on, on websites now. What it means is there is a real risk, a substantial risk to anybody investing at this time. You are absolutely right that this is the Wild West. What the SEC is saying is there is one type of disclosure and regulatory system that you have to stuff yourself into. There is nothing wrong with coming up with a parallel regulatory and disclosure system that either operates within the SEC's, umbrella or through another agency.
You brought up something about, companies meeting with the SEC and then getting a Wells notice. And I'm assuming, this is a wild guess, that you're talking about Coinbase. So their complaint here is exactly this, is that they spent millions of dollars, they showed up to the SEC's offices. They had their, briefcases in hand and their laptop with spreadsheets and, PowerPoint presentations and all that. They were all ready. And guys, we want to work with you. And here's what we do. And we even filed an S1 and it had all that stuff in the S1. What do? And then the SEC basically said, come back in a couple of weeks. We'll talk to you. And then they served them a Wells notice. Now, is that normal behavior for the SEC, or is that kind of something weird? And if it's something weird, why?
Well, it's not clear to me whether it's weird or not. What is distressing is that the SEC does not usually give a lot of guidance to a company as to whether it's violating the laws or not, at least from the enforcement side. Now, from the regulatory side, from the market regulation and the corporate finance side, the SEC gives lots of advice to market participants and guidance. But again, I think there is a huge reputational risk here. There's a huge regulatory risk. The SEC does not want to be seen to have approved something and then find out that there was a big fail. So the SEC feels pretty comfortable saying, oh, gee, investors, you've lost a bunch of money, but look at us. We're doing, we're the good guys. We're bringing all these enforcement actions. That changes if you now have a market participant like, it's a JP Morgan Chase or Citibank, and they fail. Then people say, wait a minute, you SEC regulate those people. Where were you? You were asleep at the switch. So I think this is, there always is a disconnect between an innovative industry and a government regulator, because government moves more slowly. The law just moves more slowly. But here, we have a system, and I understand crypto does not fit perfectly within the current system that we have for broker dealers, for exchanges. That does not mean that there can't be something else and a parallel system, that you can't have special rules that apply. That has not been apparently what the SEC has been willing to propose via proposed regulations, nor has it been something that the SEC has been able to work out with either Ripple or Coinbase or anybody else who's shown up at their door.
Does this actually defeat the purpose, though, or defeat the attempts by the SEC to say, hey, we want you guys to come in through the door. We want to work with you. We want to work with companies before they do something wrong. And it sounds like Coinbase was saying that's what they were saying. Although my guess from what you're saying is that the attitude of the SEC was, hey, you guys already launched these products before you talked to us about it. Therefore, we're gonna punish you because you already did it. You already started. Is that kind of what you're going with here?
Yes, that's a problem. But we know that in this industry, people move fast, and they can't. I mean, we have the Winklevoss brothers twins who've been waiting to get approval. And have they gotten it? No. So, these are business risks that I think various companies are taking on. And as a big established participant in the crypto industry, I think, Coinbase was well positioned to say, we'll take that risk. We will launch and keep talking with the government. And, it didn't work out.
Lisa, speaking of innovations, I mean, Emily was talking about the algorithmic stablecoin. We start off with Do Kwon. Well, Tron founder Justin Sun also has an algorithmic stablecoin called USDD, and he's being sued by the SEC on securities market manipulation charges here. But again, with Do Kwon, he was served in the United States at a conference in New York in spring of 2021. He stayed out of the U.S. after that. Nothing came of it. Justin Sun, I understand he is based in Switzerland, in Geneva. So what can be done in this situation with someone who is ex-U.S.?
Well, it is artful of them and smart to stay outside of the reach of, the U.S. To try to avoid service. It's a tried and true tactic, but the SEC is experimenting with other ways, and courts are experimenting with other ways to affect service. Recently, there was a use of the blockchain to affect service on somebody who, was out there. I can't remember if it was an unknown party. Sometimes there are John Does, Jane Does in complaints, but I believe it was just a non-U.S. named party. So, U.S. regulators, U.S. government is working through this. Courts are understanding. So I don't think that just physically staying outside of the U.S. is going to be the answer in all these cases. I think, courts are going to figure out how to affect service. And there are ways to do it via
the
treaties.
long arm of the SEC and the patience of the law. All right, Lisa, thank you so much for joining us. That was former SEC Enforcement Branch Chief and Bragança Law Attorney, Lisa Bragança.